What the UK really has at the moment is an affordability problem caused by cheap debt. Good afternoon, welcome to the Market Wrap number 92, designed really just as a discussion document, some educational pieces and a bit of enjoyment for yourselves, for our clients, potential investors, just to let you know what's going on. Stuart Williamson here at the helm. Please do subscribe and like. This week, all the signs are telling us now that there's going to be no market crash in 2022. Last week we had a number of comments on the Market Wrap about there being a UK property correction coming up, perhaps not now, but perhaps at the end of the 18-year market cycle. Specifically thanks to Mr. Andrew Barton for commenting, but all the rest of you out there, we have over 1,000 subscribers now and 100 likes, so thank you very much for that. Please do subscribe and like if you can. So this week we'll be covering why the market crash is not happening now, what will happen when it does, what are the three factors supporting it, what is the 18-year cycle, and I'm going to cover all this at the end, but now I'm just going to go through why no crash, what are the supporting aspects. Let's look at the new data that's come out this week. Okay, this gives us an indication of why there isn't a crash on the horizon. In February, a record 43% of homeowners sold their home for more than the asking price, according to Hamptons, the estate agency. In February 2019, before pandemic, it was 16% of sellers achieved more than the asking price. Even the most stretched of would-be homeowners seem to have accepted that overbidding is the new normal. First-time buyers were the most likely to pay above asking price, with more than half doing so over the last month. Half of all first-time buyers. A record number of landlords also paid over the asking price, some 38%. I mean, we've been involved in this with clients from overseas. It's very difficult to get into the market because it is so competitive and we are paying over the odds, and it's a bit of FOMO, isn't it? Fear of missing out. The figures are indicative of a property market that has shown no signs of cooling. House prices have defied expectations, as we expected at the beginning of 2022, a slowdown. And the country is entering its worst cost of living crisis for a whole generation. House prices have actually jumped by 10.8% in the year to February, the sharpest growth since before the financial crisis of 2007, according to Halifax. Despite comparisons to previous crises and its subsequent housing market crashes, experts, however, say that history is not doomed to repeat itself. Okay, it's not doomed to repeat itself. So just have a look at this chart. It shows the record of 43% of homes sold above asking price. What the UK really has at the moment is an affordability problem caused by cheap debt. Wage growth has consistently failed to keep up with soaring house prices over the last number of years and is now sending affordability to a record low. Buyers now need 7.7 times their income to afford an average home, according to Capital Economics. This has surpassed a previous peak of 7.5 that was before the 2008 financial crisis. However, this affordability problem has been masked by record low mortgage rates and people who've done huge amounts of saving during the pandemic. However, it's generally viewed now that rampant inflation and a high cost of living are threatening to pull that safety net away from borrowers. Anisha Beveridge, great name, of Hampton said, "The increase in cost of living has been harsher and more persistent than many expected, and this may result in a faster and higher interest rate rise than first anticipated." And she goes on to say, "This could slow the market and is particularly likely to weigh on first-time buyers whose incomes are being squeezed by soaring inflation." Mortgage rates have steadily climbed since October last year, and borrowers are already paying hundreds of pounds more in interest each year as a result. I mean, that's a bit of fantasy really. They have gone up a bit, but not by a huge amount. It's just people talking up a correction. So according to this, surely there is a correction due. So is it time to sell our property? Should we be buying cryptos? Should we be buying gold? Is it time to get out? According to Capital Economics, the answer is no. And the first reason is interest rates are still low by historical standards and are expected to cushion any house prices from a sharp fall. Okay, Andrew Burrell of Capital Economics said, even if the Bank of England increases interest rates to 2% next year, which is 1.5% more, as they are forecasting, mortgage payments will still be much more affordable than they were in 1989 or 2007, the previous two property crashes. And he goes on to say, we do not anticipate house prices collapsing under their own weight. Capital Economics are still predicting strong house price growth to continue right through the summer. Perhaps by the second half of the year, higher mortgage rates and inflationary drag will have dampened down demand to a crawl. So it's not the same as it was before, so it shouldn't have this crash effect. He goes on to say, only if house prices continue to rise sharply despite higher mortgage costs, or if the bank rate rises further than they anticipate, would we expect a fall. Okay, that's one factor. Secondly, the ratio of demand to housing supply is past its peak but still high. Have a look at this chart and you can see that. So this brings on the second reason why it won't crash. Replenished supply of housing stock. The recent house price boom has been underpinned by a chronic shortage of homes for sale. As long as buyer demand is so poorly matched by supply, there's little chance of those house prices cooling. And we've covered this quite a few times before on the wrap. But there are early signs that the imbalance is about to ease. New listings of homes for sale were 5% above the 5-year average in February, according to property site Zoopla. Simon Brown of Landmark Information Group, there's one we haven't used before, a property data company, said supply is definitely starting to increase, but this takes time before it has any impact on the market. So we'll be looking for a delay of a few months at least before we see that easing. He goes on to say, we will hopefully see buyer demand ease off while supply increases, and this would bring the market slowly back in line with normal levels rather than a bubble bursting. He then says it would take a huge shock of some sort to cause demand to vanish abruptly and trigger any sort of crash. Okay, so there are two strong reasons why it won't crash. And thirdly, we're not at that stage in the housing cycle. Now let's just talk about that for a second. It's a great quote. When Tony Blair and Gordon Brown entered Downing Street in 1997, I wrote to them and others, including Alistair Campbell, to explain they had 10 years in which to prevent house prices peaking in 2007. Now, who said this? It was Fred Harrison, and he's quite a famous economist in the UK. He says house prices will boom before crashing in 2026. And this is the guy who forecast the last two slumps. Will he be right this time? Okay, we don't know this. Fred Harrison conceived the concept of the 18-year property cycle. He correctly predicted the last two property crashes, and he now goes on to say that it will probably crash in 2026. If you look at the graph from the Daily Mail, This Is Money, they're potentially corroborating that. He says he's written to Boris Johnson and Rishi Sunak to explain the consequences of not stabilising the housing market, but I don't expect the government to take constructive action. Okay, so just look at that graph. It's an interesting one to see where we are, or diagram, whichever you want to call it. So where are we in the cycle? If Harrison's 18-year property forecast is to be believed, it would mean we're a third of the way into the boom phase. So what can we do to prepare for this crash? Change our strategy? Sell up? I mean, these are all things you can do. But what we would suggest is we look at what has happened in the past and what the future may potentially hold. So in the 1990s housing crash, property fell between 20% between 1989 and 1993. In the credit crunch of 2008 to 9, average UK house prices also fell by 18% over 16 months. And this is in the midst of the worst global financial financial crisis since the Great Depression. Far worse than we've been going through with COVID. However, 4 years later, so 4 years after it crashed, the very start, it was back at its pre-crash levels. And the market has now recovered and is today 35% higher than those pre-crash levels. So if you use a little rule of thumb calculation, based on house prices crashing in 2025, they should be at that stage at £300,000 average, and they would fall to 255,000 based on previous figures. Before then taking 4 years to recover, and then be at 405,000 on average by 2035. So in the bigger picture of the last 30 odd years I've been involved in this, it's a small dip. Can we believe all this? Is it true? Who knows? Black swan events like COVID may have broken the model, the Ukraine may have broken the model, all those sort of things. But what we do know is the two fundamentals are that there's still a housing shortage and interest rates are super low. And as I've said before, the stress testing that's been done on these mortgages is far better than it was before. We're not in line for a crash. We are in line for a calming down or a crawl. So keep at it, keep buying. Bigger picture, if we're buying for pensions, it doesn't matter. It's a 15, 20, 25 year buy. If we're buying for educational fees, it's the same thing. So it's a long-term game. Time in the market, not timing the market. Thank you very much. Hope you enjoyed that. Cheerio.